really controls the economy? The Federal Reserve and the questions that won't go away. Money is one of the few forces that touches nearly every part of modern life. Yet most people rarely see how it actually moves. Paychecks arrive, prices rise and fall, interest rates change, markets react, recessions come and go. For many, these shifts feel distant and abstract until they suddenly are not. A mortgage becomes unaffordable. Savings lose value. Jobs disappear. When that happens, a question often surfaces quietly, almost instinctively. Who decides when this happens? At the center of that question sits an institution most people know by name, but very few understand in detail: the Federal Reserve. It does not pass laws. Its leaders are rarely household names. It does not appear on ballots. And yet, its decisions influence borrowing costs, employment conditions, inflation, and the overall direction of the economy. To some, this influence represents a necessary stabilizing force. To others, it feels like something else entirely. The central mystery surrounding the Federal Reserve is not whether it is powerful. That much is openly acknowledged. The question is more subtle and more unsettling. Was this institution designed primarily to protect the economy from chaos? Or was it structured in a way that allows economic outcomes to be guided, shaped, or controlled in ways the public does not fully see? This documentary does not attempt to answer that question definitively. Instead, it examines how the question came to exist in the first place. It explores the historical conditions that gave rise to the Federal Reserve, the official explanation for its creation, and the reasons why skepticism, confusion, and alternative interpretations have persisted for more than a century. What follows is an examination of documented history, public debate, and the theories that grew in the spaces where certainty was difficult to find. To understand why suspicion became possible, it is necessary to step back into a time before the Federal Reserve existed at all. In the late 19th and early 20th centuries, the United States experienced repeated financial panics. Banks failed suddenly. Depositors lost their savings. Credit vanished almost overnight. These crises were not rare or isolated. They occurred with enough frequency that economic instability became a defining feature of American financial life. Unlike many European nations, the United States had no permanent central banking authority to act as a lender of last resort. Instead, the system relied on a patchwork of private banks, regional institutions, and informal arrangements. When panic struck, fear spread quickly. People rushed to withdraw their money. Banks, unable to meet sudden demand, collapsed. Businesses failed not necessarily because they were unprofitable, but because credit froze. The consequences were immediate and visible. Unemployment rose. Wages fell. Entire communities were affected. These repeated crises created pressure for reform. Economists, politicians, and financial leaders began debating whether a centralized authority could prevent such collapses by managing liquidity and confidence. The idea was not universally welcomed. In fact, it was deeply controversial. America's relationship with central banking had always been uneasy. Earlier attempts at national banks in the 19th century had ended amid accusations of corruption, elitism, and overreach. Many citizens believed concentrated financial power was inherently dangerous. Farmers and laborers feared that a central bank would favor industrialists and financiers. Others worried that giving any single institution authority over money would undermine democracy itself. At the same time, powerful financial interests argued that instability was the real threat. Without a central authority to coordinate responses to crises, the economy remained vulnerable to sudden collapse. They claimed that a central bank could act as a neutral stabilizer, stepping in during emergencies to protect both banks and the public. These competing fears shaped the political and cultural climate of the era. On one side was the fear of chaos. On the other was the fear of control. Both were grounded in lived experience. Neither could be easily dismissed. As discussions continued, the technical nature of banking and monetary policy created another problem. The subject was complex. Even those directly involved often spoke in specialized language. For the average citizen, understanding how money was created, moved, and regulated was difficult. This gap between expertise and public understanding would later become one of the most important factors in the story that followed. Against this backdrop, a group of influential figures began drafting plans for a new financial system. They included bankers, economists, and policymakers who believed the existing system was unsustainable. Their goal, at least on paper, was to design an institution capable of preventing future panics without placing too much power in any one set of hands. The resulting structure would eventually be presented as a compromise. It would not be a single, monolithic national bank. Instead, it would be a system composed of regional banks overseen by a central board. This hybrid design was meant to balance public oversight with private sector expertise. Supporters argued it reflected American values of decentralization and checks and balances. But even before the system officially existed, controversy surrounded the process by which it was conceived. Key planning meetings took place away from public view. The details were not widely disclosed until years later. While secrecy was defended as necessary for open discussion, it also planted the seeds of suspicion. For critics, the lack of transparency suggested that decisions affecting the entire nation had been made by a small group of insiders. When the Federal Reserve Act was eventually passed in 1913, it did so through legitimate legislative means. Congress debated it. Amendments were made. The president signed it into law. From a legal standpoint, the process was straightforward. From a public trust standpoint, the reaction was more complicated. Some celebrated the creation of a system designed to protect the economy from collapse. Others warned that the country had just handed immense power to an institution that operated largely beyond public scrutiny. These concerns were not fringe beliefs at the time. They appeared in newspapers, political speeches, and academic debates. What made the situation particularly complex was that both sides could point to real problems. Financial panics were real. Economic instability was real. So was the fear that concentrated power, even if well-intentioned, could be misused or drift away from public accountability over time. As decades passed, the Federal Reserve became a permanent fixture of American economic life. Its role expanded. Its tools grew more sophisticated. Its decisions increasingly shaped global markets, not just domestic ones. With each crisis it responded to, new questions emerged about how much influence it wielded and how that influence was exercised. Importantly, many of these questions did not arise from secret documents or hidden meetings, but from visible outcomes. Inflation eroded purchasing power. Asset prices climbed faster than wages. Economic recoveries appeared uneven. For some observers, these patterns suggested that the system benefited certain groups more than others. For others, they reflected the unavoidable trade-offs of managing a complex, interconnected economy. This divergence in interpretation is where speculation begins to form. When systems are complex and outcomes feel unfair, people look for explanations that go beyond surface-level mechanics. They ask not just how something works, but why it works the way it does. In the case of the Federal Reserve, that curiosity has persisted for more than a century. It is important to pause here and acknowledge what this exploration is and is not. This documentary examines theories, interpretations, and public debate surrounding the Federal Reserve's design and purpose. It does not assert that the institution was created with malicious intent, nor does it claim that alternative explanations are factual. Instead, it traces how uncertainty, secrecy, and power combine to produce enduring questions. Those questions did not emerge overnight. They developed slowly, shaped by history, crisis, and perception. To understand why conspiracy theories surrounding the Federal Reserve gained traction, it is first necessary to understand how the official story explains its existence and function. That story begins with a promise: stability. In the next section, we will step fully into the mainstream narrative. We will examine how the Federal Reserve describes its own role, how it justifies its independence, and how supporters argue that its design reflects necessity rather than control. Only after that foundation is established can alternative interpretations be meaningfully explored. For now, the question remains open, not as an accusation, but as an inquiry. When an institution is powerful, complex, and partially hidden from view, how do we determine whether it serves the public, shapes outcomes, or simply reflects the tensions of the system it was built to manage? The official narrative. From the perspective of its architects and defenders, the creation of the Federal Reserve was not an attempt to control the economy, but an effort to prevent it from repeatedly falling apart. The official narrative begins with a simple premise. Modern economies require a mechanism to manage money, credit, and confidence, especially during moments of crisis. Before 1913, the United States lacked a permanent institution capable of responding quickly and consistently to financial panics. When banks failed, there was no central authority to inject liquidity or calm markets. Responsibility fell to private financiers, ad hoc coalitions, or state-level solutions, none of which were reliable or universally trusted. Supporters of reform argued that this absence of coordination was not just inefficient, but dangerous. According to official accounts, the Federal Reserve was designed to solve three core problems. First, to provide a stable and flexible supply of money. Second, to act as a lender of last resort during financial stress. Third, to oversee and regulate banks in a way that reduced the risk of systemic collapse. These goals were presented as technical necessities rather than political ambitions. The Federal Reserve Act of 1913 was the legislative response to those concerns. The law established a central banking system, unlike those in Europe. Rather than creating a single national bank fully controlled by the federal government, lawmakers opted for a hybrid structure. This design reflected the political compromises of the time and the deep suspicion many Americans held toward centralized power. At the top of the system sits the Board of Governors, a federal agency whose members are appointed by the President and confirmed by the Senate. This board is tasked with setting broad policy direction and ensuring that the system operates in the public interest. Beneath it are 12 regional Federal Reserve banks, each serving a specific geographic area. These regional banks interact directly with commercial banks, gather economic data, and implement policy decisions. Supporters argue that this structure was intentional. By distributing authority across regions, the system aimed to prevent domination by any single financial center. By combining public oversight with private sector expertise, it sought to balance accountability with operational effectiveness. In official descriptions, this was not secrecy, but decentralization. One of the most frequently cited justifications for the Federal Reserve's design is independence. Central banks, according to mainstream economic theory, function best when insulated from short-term political pressures. Elections, budget cycles, and public opinion can incentivize decisions that feel good immediately, but destabilize the economy over time. Independence, proponents argue, allows monetary policy to focus on long-term stability rather than short-term popularity. This independence is not described as absolute. The Federal Reserve is required to report to Congress regularly. Its leaders testify publicly. Its financial statements are audited. Meeting minutes are released with a delay. From the official standpoint, these measures provide transparency while preserving the ability to act decisively during crises. The tools the Federal Reserve uses are often presented as neutral instruments rather than mechanisms of control. Interest rates influence borrowing and spending. Open market operations adjust the supply of money by buying or selling government securities. Reserve requirements determine how much capital banks must hold. In official explanations, these tools are compared to levers that fine-tune the economy, not switches that dictate outcomes. Supporters also point to historical moments where the Federal Reserve is credited with preventing worse outcomes. During periods of financial stress, it has provided emergency liquidity to banks, stabilized markets, and coordinated responses with other central banks. In these accounts, the absence of such intervention would have resulted in deeper recessions, higher unemployment, and greater hardship. Importantly, official narratives do not claim perfection. Federal Reserve leaders have publicly acknowledged policy mistakes. The Great Depression is often cited as a period when monetary policy failed to respond adequately. More recent crises have sparked debate over whether interventions went too far or not far enough. Within the mainstream view, these are presented as errors in judgment rather than evidence of hidden motives. Transparency plays a central role in the institutional defense of the system. Over time, the Federal Reserve has increased the amount of information it releases. Policy frameworks are published. Economic projections are shared. Press conferences accompany major decisions. These changes are framed as responses to public demand for clarity rather than concessions to suspicion. From this perspective, confusion surrounding the Federal Reserve is seen as an unavoidable byproduct of complexity. Monetary policy involves forecasting, uncertainty, and trade-offs. Outcomes are influenced by global events, technological change, and human behavior. When results are disappointing or uneven, the institution argues that this reflects the limits of economic management, not intentional design. The official narrative emphasizes internal consistency. The stated mission of price stability and maximum employment aligns in theory with the actions taken. Interest rates are raised to cool inflation, lowered to stimulate growth. Emergency measures are framed as temporary responses to extraordinary circumstances. Oversight mechanisms, while imperfect, are portrayed as real and functioning. Critically, defenders argue that the alternative is worse. Without a central bank, financial systems are more vulnerable to panic. Credit dries up more quickly. Recovery becomes slower and more painful. From this view, the Federal Reserve does not eliminate economic cycles, but it reduces their severity. Within mainstream economics and policymaking, the question is not whether the Federal Reserve controls the economy, but whether it can effectively manage risk in an inherently unstable system. Control in this framing is neither the goal nor the outcome. Stability is. Yet even within this official account, there are tensions that are openly acknowledged. Independence can look like unaccountability. Technical language can feel like obfuscation. Decisions made by unelected officials inevitably raise questions in a democratic society. These concerns are not denied, but they are treated as challenges to be managed rather than flaws in intent. The official story, then, is one of necessity, compromise, and gradual adaptation. A system built to solve a recurring problem. An institution shaped by fear of both chaos and concentration of power. A structure that attempts to walk a narrow line between intervention and restraint. Understanding this narrative is essential, not because it resolves suspicion, but because it establishes the framework against which alternative interpretations emerged. The theories that followed did not arise in a vacuum. They formed in response to this very explanation, testing its assumptions, questioning its outcomes, and probing the spaces where official clarity gave way to ambiguity. In the next section, we will move away from institutional voices and into the early critics. These were not modern internet theorists, but contemporaries of the Federal Reserve's creation, who questioned its purpose from the beginning. Their ideas, shaped by the politics and fears of their time, would lay the foundation for a much broader debate that continues today. The first wave of conspiracy theories. Opposition to the Federal Reserve did not begin decades later in online forums or documentary films. It emerged almost immediately, shaped by the same political tensions and economic fears that surrounded its creation. Long before the term conspiracy theory carried its modern meaning, critics raised concerns that went beyond policy disagreements and into questions of intent. Many of the earliest skeptics were not outsiders. They were politicians, journalists, economists, and public figures who had lived through repeated financial panics and distrusted the concentration of financial power. For them, the issue was not whether reform was needed, but who would benefit most from that reform. One of the most frequently cited moments in these early critiques is the 1910 meeting on Jekyll Island, a private retreat off the coast of Georgia. A small group of influential bankers and policymakers gathered there to draft the framework that would later influence the Federal Reserve Act. At the time, the meeting was kept confidential. Participants traveled under assumed names, and its existence was not publicly disclosed. When details of the meeting later became known, it fueled suspicion. critics questioned why an institution meant to serve the public was designed in private by a select group of financial elites. Supporters argued that secrecy was necessary to allow open discussion without political pressure. Skeptics saw something else: evidence that the system had been shaped primarily by those with the greatest financial stakes. Early alternative explanations did not necessarily claim a unified plot or global coordination. Instead, they focused on influence. Critics argued that bankers, by virtue of their expertise and resources, had an outsized role in shaping the system. They questioned whether a structure influenced so heavily by private interests could truly operate in the public interest. These concerns found fertile ground in the political culture of the time. Populist movements were already skeptical of monopolies and trusts. The idea that a central banking system might entrench financial power rather than limit it felt plausible to many. Newspapers published editorials warning that the Federal Reserve would favor Wall Street over ordinary citizens. Political speeches framed the system as a betrayal of democratic control over money. Another early line of criticism centered on the nature of money itself. Some argued that allowing banks to create money through lending fundamentally altered the balance of power in the economy. Debt-based currency, in this view, benefited those who controlled credit while placing long-term burdens on borrowers. The Federal Reserve, by formalizing and overseeing this system, was seen by critics as institutionalizing inequality rather than correcting it. These ideas resonated particularly during periods of economic stress. When recessions followed the Fed's creation, skeptics pointed to them as evidence that the system either failed to prevent instability or was not designed to do so in the first place. Each downturn reinforced the belief that official promises of stability were incomplete or misleading. Importantly, early critics did not all agree with one another. Some believed the Federal Reserve was too weak to counter powerful banks. Others believed it was too strong and insufficiently accountable. Still others viewed it as a necessary institution corrupted by compromise. What united them was a shared discomfort with opacity and concentration of authority. Cultural factors also played a role. Financial systems were becoming more abstract. Gold-backed currency gave way to more flexible monetary arrangements. For many citizens, money no longer felt tangible or grounded. This abstraction made it easier to imagine hidden mechanisms and unseen hands guiding outcomes. By the 1920s and 1930s, these early theories had entered popular discourse. Pamphlets circulated, books were written, radio broadcasts debated the nature of central banking. The Great Depression intensified scrutiny as millions struggled to reconcile the existence of a powerful monetary authority with widespread economic suffering. At this stage, the theories remained relatively contained. They focused on national power rather than global domination. They questioned design rather than alleging coordinated manipulation. They were rooted in specific historical moments and shaped by contemporary fears. What makes this first wave significant is not whether its claims were accurate, but why they emerged so quickly and persisted so stubbornly. The Federal Reserve's complexity, combined with its real influence and partial opacity, created space for interpretation. Where explanations felt incomplete, alternative narratives took hold. These early theories established a pattern that would repeat over time. Economic hardship would prompt renewed attention. Institutional reassurances would coexist with public doubt. Each cycle added layers to the debate, expanding it beyond policy into questions of power and intent. As decades passed, new evidence would be cited, new patterns identified, and new media would amplify old concerns. But the foundation was laid early, at the moment when the Federal Reserve first stepped into its role as steward of the nation's monetary system. In the next section, we will examine the specific documents, patterns, and perceived anomalies that supporters of these theories point to as evidence. Rather than tracing origins, we will explore why belief endures, focusing on what people see, interpret, and connect as they try to make sense of an institution that remains both central and elusive. Evidence and patterns cited by supporters. For those who believe the Federal Reserve was designed to shape or control economic outcomes rather than simply stabilize them, the argument rarely rests on a single document or revelation. Instead, it is built from patterns, structures, and interpretations layered over time. Supporters often describe their position not as belief in a secret plot, but as a conclusion drawn from how the system operates in practice. One of the most frequently cited elements is the Federal Reserve's structural design. Supporters point to its hybrid public-private framework as inherently unusual. While the Board of Governors is a federal agency, the regional Federal Reserve banks interact closely with private commercial banks, which hold membership shares. To critics, this structure appears to blur the line between public service and private interest. From a verified standpoint, this hybrid model exists and is openly acknowledged. Where interpretation diverges is in what that structure implies. Supporters argue that it creates built-in incentives favoring the financial sector, even when policies are framed as serving the broader economy. Critics of this view counter that ownership shares do not function like traditional corporate control. At this stage, however, supporters focus on the perception of influence rather than formal authority. Another frequently referenced area involves documentation and records. Meeting minutes from policy discussions are released with delays. Certain materials are redacted. Emergency lending programs, especially during crises, are disclosed only after the fact. Supporters argue that this lag undermines real-time accountability and prevents meaningful public scrutiny when decisions matter most. Here, the distinction between fact and interpretation becomes important. It is verifiable that disclosures are delayed and that some records are redacted. What remains disputed is whether this reflects practical necessity or intentional concealment. Supporters tend to interpret opacity as evidence that the public is not meant to fully understand how decisions are made. Economic patterns form another pillar of belief. Supporters often point to long-term trends that appear inconsistent with the stated goals of stability and shared prosperity. Asset prices have grown faster than wages. Wealth concentration has increased. Inflation has eroded purchasing power unevenly across income groups. These outcomes are real and measurable, though their causes are widely debated. For believers, the persistence of these patterns suggests that the system may be functioning as designed, even if the design is not openly acknowledged. The argument is not always that policymakers intend harm, but that the framework itself channels benefits upward. Monetary expansion, in this interpretation, reaches financial markets before it reaches households, creating what supporters describe as structural advantage. Coincidences and timing also feature prominently in supportive narratives. Interest rate changes often precede market shifts. Emergency interventions sometimes align with moments of extreme financial stress for major institutions. While economists explain these actions as reactive, supporters argue that the consistency of outcomes raises questions about predictability and foresight. Again, it is important to separate observation from conclusion. The timing of decisions and market reactions is factual. The interpretation that this reflects advanced knowledge or preferential treatment remains speculative. Supporters emphasize the pattern rather than the proof. Media coverage is another recurring theme. Supporters often argue that mainstream outlets focus on surface explanations while avoiding deeper structural critique. Technical language, they say, discourages public engagement. When coverage does occur, it tends to frame decisions as inevitable rather than contestable. This perception is reinforced by the complexity of monetary policy itself. The mechanics of bond markets, interest rates, and liquidity facilities are difficult to explain simply. Supporters argue that this complexity acts as a barrier, whether intentional or not, between decision-makers and the public. In this view, misunderstanding is not accidental, but structural. Symbolic interpretations also play a role. The language used by central banks often emphasizes management, tools, and levers. For some, this terminology suggests a level of control inconsistent with democratic ideals. Debt-based money, in particular, becomes a focal point. Supporters argue that a system built on perpetual borrowing inevitably transfers power to those who control credit. It is here that speculation becomes most pronounced. Claims about intentional design, long-term planning, or coordinated outcomes move beyond what can be verified. Supporters often acknowledge this gap, but argue that absence of proof is not proof of absence, especially within opaque systems. What sustains belief is not any single anomaly, but accumulation. Each delayed disclosure, each crisis response, each unequal outcome is added to a growing archive of suspicion. Over time, these elements form a narrative that feels coherent to those who hold it, even if individual components remain contested. Importantly, many supporters do not reject the official narrative outright. Instead, they see it as incomplete. They argue that stability and control are not mutually exclusive, and that an institution can sincerely pursue one while exercising the other. In this framing, the Federal Reserve does not need malicious intent to produce outcomes that feel manipulative or unfair. This perspective thrives in environments of uncertainty. When economic explanations feel abstract and lived experience feels concrete, people privilege what they can see and feel. Rising costs, stagnant wages, and financial insecurity become evidence, not of policy failure alone, but of systemic design. At this stage of the story, belief persists not because of proven wrongdoing, but because of unresolved tension between stated purpose and perceived outcome. The gap between intention and effect becomes the space where interpretation lives. In the next section, we will examine how these ideas evolved over time, how new media amplified them, and how counter-analysis emerged in response. We will explore how skepticism and belief interacted, reshaped each other, and continue to coexist in an era defined by information overload and institutional mistrust. Evolution, amplification, and counter-analysis. As the decades passed, skepticism surrounding the Federal Reserve did not disappear. Instead, it adapted. Early critiques rooted in national politics and banking reform gradually expanded, shaped by new crises, new technologies, and new ways of sharing information. What began as focused concerns about influence and design evolved into broader narratives about power, coordination, and global systems. One major turning point came during periods of economic upheaval. The Great Depression, post-war inflation, the collapse of the Bretton Woods system, and later financial crises each renewed attention on central banking. Every intervention, especially those involving large-scale monetary expansion, became a moment of reassessment. Supporters of alternative interpretations viewed these moments not as exceptions, but as confirmations of long-held concerns. As global finance became more interconnected, theories expanded beyond national borders. The Federal Reserve was increasingly discussed alongside other central banks and international financial institutions. Some narratives began framing monetary policy as part of a coordinated global system, rather than a series of national decisions. This shift marked a clear evolution from early skepticism toward more expansive interpretations. The rise of the internet dramatically changed how these ideas circulated. Forums, blogs, and later video platforms allowed individuals to bypass traditional media and speak directly to large audiences. Complex economic concepts were condensed into accessible narratives. Charts, clips, and simplified explanations spread rapidly, often detached from their original context. This new environment favored clarity over nuance. Long-standing debates were reframed as revelations. Questions became assertions. Patterns became proof. While this made ideas more digestible, it also made them more rigid. Once embedded in online communities, interpretations were reinforced through repetition and selective exposure. Documentaries and books played a significant role in this amplification. Some presented historical facts alongside speculative conclusions, leaving viewers to draw their own connections. Others blurred the line more explicitly, presenting narrative coherence as evidence of intent. Viral moments, particularly during crises, brought renewed attention to these works and introduced them to audiences already primed by economic anxiety. Public perception shifted accordingly. After the 2008 financial crisis, distrust of financial institutions surged. Emergency bailouts and unconventional monetary policy intensified scrutiny. For many observers, it was difficult to reconcile massive interventions with claims of neutrality. The pandemic-era response further accelerated these debates, as unprecedented levels of money creation entered public discussion. At the same time, counter-analysis grew more visible. Economists, historians, and policy experts responded directly to popular claims. They argued that monetary policy decisions are often reactive rather than predictive, constrained by incomplete information and competing risks. From this perspective, apparent patterns reflect structural limitations, not hidden coordination. Skeptics of conspiracy narratives pointed to internal disagreements within the Federal Reserve itself. Policy debates are documented. Dissenting votes are recorded. Public statements often reveal uncertainty rather than confidence. Coordinated control, they argue, would require a level of unity and foresight that contradicts the historical record. Logical challenges were also raised. Critics asked how sustained manipulation could persist across decades, administrations, and crises without conclusive evidence. They highlighted instances where Federal Reserve actions produced politically unpopular or economically painful outcomes, questioning why an institution seeking control would undermine its own credibility. Alternative explanations for inequality and instability were offered. Globalization, technological change, fiscal policy, and demographic shifts all shape economic outcomes. From this view, monetary policy is only one variable among many. Assigning primary responsibility to the Federal Reserve oversimplifies a system defined by interdependence. Despite these critiques, belief did not fade. For many, counter-arguments felt abstract compared to lived experience. Charts and models could not easily explain why financial recovery felt uneven, or why trust in institutions remained low. In this environment, narratives emphasizing intentional design retained emotional power. Another factor sustaining belief is the nature of modern information ecosystems. Algorithms reward engagement, not accuracy. Content that provokes suspicion or revelation spreads more effectively than content emphasizing uncertainty. Over time, audiences are guided toward increasingly definitive interpretations, even when the underlying evidence remains ambiguous. Importantly, belief often persists without requiring absolute certainty. Many supporters describe their position as provisional rather than dogmatic. They acknowledge gaps in evidence, but argue that skepticism is justified given the stakes involved. For them, questioning power is not paranoia, but vigilance. This dynamic creates an enduring tension. On one side are institutions emphasizing complexity, trade-offs, and imperfect tools. On the other are audiences seeking clarity, accountability, and reassurance that outcomes are not arbitrary or manipulated. Neither side fully satisfies the other. What emerges is not a resolved debate, but a layered discourse. Theories evolve, counter-arguments respond. Public perception shifts with each crisis. The conversation itself becomes part of the story, shaped as much by psychology and media as by policy and history. In the final section, we will step back from the arguments themselves and examine their broader impact. Rather than asking which explanation is correct, we will explore what these debates reveal about trust, uncertainty, and the human need to find meaning within systems that are vast, abstract, and deeply consequential. Impact and uncertainty. By this point in the story, the question surrounding the Federal Reserve is no longer only about economics. It is about trust, about how people relate to institutions that shape their lives but remain largely invisible, and about how uncertainty, when left unresolved, can become something more enduring than any single explanation. For many people, the belief that the Federal Reserve may have been designed to guide or control economic outcomes is not rooted in ideology, but in experience. Inflation feels personal. Job loss feels personal. Debt feels personal. When these experiences repeat across generations, they create a sense that something structural is at work, even if its contours are difficult to define. Psychologically, this response is not unusual. Humans are pattern-seeking by nature. When outcomes appear consistent, but explanations feel abstract, people look for narratives that restore a sense of coherence. Intentional explanations, even unsettling ones, can feel more reassuring than randomness or complexity. A system that is controlled, even by unseen forces, can feel less frightening than one that is merely unpredictable. Culturally, debates about the Federal Reserve reflect broader anxieties about power imbalance. The institution sits at the intersection of finance, government, and expertise. It influences markets without being directly elected. Its language is technical. Its decisions are consequential. These characteristics make it a natural focal point for suspicion in a society that values transparency and democratic accountability. Media environments intensify this effect. Modern platforms reward certainty, clarity, and emotional resonance. Content that frames economic outcomes as the result of deliberate design spreads more easily than content that emphasizes uncertainty and trade-offs. Over time, algorithms amplify the most compelling narratives, not necessarily the most cautious ones. This does not mean that skepticism is irrational or unfounded. History offers many examples of institutions acting in ways that benefited some groups more than others. It also offers examples of secrecy being used to avoid scrutiny rather than to protect deliberation. Questioning power, particularly economic power, is a long-standing and often healthy part of public discourse. What complicates the Federal Reserve debate is the absence of definitive closure. Many records are available, but not all are complete. Some decisions are explained, others remain contested. Economic outcomes can be traced, but causation is rarely singular. Each answer seems to generate new questions. There are unresolved elements that continue to invite interpretation. How should independence be balanced with accountability? At what point does technical necessity become democratic distance? Can an institution be structurally neutral in a system marked by inequality? These are not questions with simple resolutions, and they extend beyond any single organization. It is also worth noting that disagreement does not imply deception. Many of the tensions explored here can exist without malicious intent. A system designed to stabilize can still produce uneven outcomes. A structure meant to balance interests can still feel opaque. Complexity itself can become a source of mistrust. In that sense, the persistence of conspiracy theories surrounding the Federal Reserve may say as much about society as it does about the institution. They reflect a desire to understand forces that feel overwhelming. They express frustration with explanations that feel distant or incomplete. And they reveal how deeply economic systems shape not just material conditions, but collective imagination. As this documentary comes to a close, no final verdict is offered. The question remains open, deliberately so. Was the Federal Reserve designed solely to stabilize the economy? Or does its structure allow for a degree of control that is rarely acknowledged? Different observers will answer that question differently, guided by their experiences, values, and trust in institutions. What can be said with certainty is that the debate itself is unlikely to disappear. As long as money remains central to daily life, and as long as economic decisions are made beyond the immediate view of the public, questions about power and intent will persist. Before concluding, it is important to state clearly that the theories and interpretations discussed in this documentary are presented for informational and discussion purposes only. No claims are asserted as fact. No intent is made to defame, accuse, or misrepresent any individual or institution. This exploration reflects public discourse, historical debate, and speculative interpretation, rather than established conclusions. Thank you for spending this time with Whims and Whispers. If you found this exploration thoughtful or engaging, consider liking the video and subscribing to the channel. Your support helps these long-form investigations continue. And if there is another conspiracy, historical mystery, or unresolved question you would like to see explored next, share it in the comments. Until then, this has been a story not about answers, but about how questions endure, especially when they touch the systems we rely on most, yet understand the least.